Thanks everybody for joining. We are presenting today on corporate venture capital. I am Alfredo Silva. I am the co-chair of our firm's Social Enterprise and Impact Investing Practice Group here at MoFo. I work on the Pro Bono Committee, our strategy committee, and work basically on a lot of different kinds of corporate transactions, including a lot of venture capital on both the company side and investor side. But in particular, when working with investors, work a lot on corporate venture capital work. So with strategics, publicly traded companies, both in the US and abroad, on their investments in startups and other minority investments in other companies, which has a slightly different flavor, as we'll talk about, than when you have a venture capital investor or private equity investor doing minority investments in other companies. And I'm joined by my colleague, Mike Krigbaum, who's a partner in our Palo Alto office. I'll let him introduce himself here.
Hi everyone, my name's Mike. I'm a partner in Palo Alto, as Fredo mentioned. And my practice focuses by and large on venture capital transactions as well as mergers and acquisitions. My background is in representing startups, although these days I mostly do investor side venture capital, particularly with a lot of corporate venture capital divisions, as well as buy side M&A, largely of venture-backed technology and life science targets, and I'm looking forward to speaking with you today.
Yeah. And Mike and I are particularly excited on behalf of Morrison Foerster to be able to present on this, because corporate venture capital, as we'll talk about, is somewhat different than regular venture capital in ways that really, play to our strengths, both because there's a lot more M&A that's involved in corporate venture capital, as well as a lot more cross-border work, as well as more involvement with sort of strategic commercial transactions and commercial partnerships and technology licenses that really, bring to bear what a full-service law firm with offices around the world like ours does. Those skills come in handy, as well as those connections with other partners and an ability to look at deals from a lot of different angles in a way that's not necessarily as relevant in more early stage and venture capital focused transactions. And we'll talk a little bit about that as we go through the presentation. So without further ado, I wanted to sort of review for everyone what it is that we're going to be talking about here. And basically, the agenda for the call is we're going to talk a little bit about the purpose of corporate venture capital and what the goals are for corporate venture capital, how corporate venture capital differs between with regular venture capital work, as well as some recent developments that we're seeing in the industry, and Mike and my kind of predictions about the future for whatever those predictions might be worth. We'll chat a little bit about setting up a corporate venture capital fund within an organization, as well as some key investment terms to think about when deploying capital into companies. And then we'll conclude with some Q&A. I'll try to leave about 5 or 10 minutes for that. And so if you have questions, put them in the chat. Just based on our ability to access the chat during the call, we'll probably try to go through the webinar first and then do the Q&A after. But do feel free to put in questions. And I'll turn over to Mike now to chat a little bit about corporate venture capital goals.
Yeah, so CVCs, the goal of a CVC, well, I guess we should probably talk about both CVC goals and the goals of an entrepreneur who's looking to take investment from a CVC. Those goals are not all that dissimilar, right? Both of them are looking usually for some sort of an enhanced commercial relationship with each other, right? That could be because they want to do joint collaboration. That could be because the startup or the early stage company sees the CVC as a potential source, a potential good customer or something like that. But kind of focusing this more towards the CVC side, CVCs are really looking for not only that joint collaboration or some sort of unique business relationship, but they're looking for oftentimes they're looking to just understand what kind of talent is out there, right? They're looking to understand what kind of new technology is coming, what kind of new science is coming, right? If it's a pharmaceutical company or something like that. And they may be exploring new markets, right? And really what I think that a lot of times, not always, but a lot of time really what that boils down to is getting an early look into a potential acquisition prospect. Not a lot of the time a CVC is coming in and saying, this thing looks interesting, but it's too early, right? I don't know how I could ever get this past a committee because it's unproven, right? But we really want to monitor it, and in a large degree, for lack of a more eloquent way to say it, we want to kind of maybe box out competitors and kind of get in early so that we kind of, we have a first run at this. And that tends to be a lot of what a CVC is doing. Entrepreneurs, they're open to that. The more attractive companies that are going to resist, the hooks, right, that a CVC might put in a company to kind of make it less attractive to other strategics that are out there. But these are terms that we definitely see, and we'll talk more about them as we go through this presentation. Next slide, Fredo, please. So big question. Fredo alluded to this. Key differences between what you might call financial VCs or typical VCs. And I think what the last slide boils down to is, financial, return on investment is not the only gauge of success of a CVC's investment, which I think is very different than a financial investor. I don't think that any CVC would tell you that return on investment is a bad thing, but I do have many clients that say that it is, the last priority on the priority list. And, getting to know that company, having access to them, and, having information rights to understand what's going on with the company are going to be the paramount place where their negotiation leverage is focused. That's important for us to know as outside counsel to a CVC, because we want to know what your concerns are, right? And every CVC is different, but we need to know what your concerns are so that we can focus our negotiation leverage and attention to what's going to matter to you. Because investment outcome, because return on investment isn't the only thing, that opens up CVCs to negotiate for various items that are a little bit different than what you probably see from a typical VC. Usually you're going to be open to a lower level of control or influence over the company, on the board, on what sort of veto rights you might have, and that's not only because you're not trying to drive their investment outcome to a large degree, but a lot of times that can just be challenging, because if you're in the space, there's going to be a skittishness from the entrepreneur group about giving you too much power, right? And so that's sort of a natural consequence of the fact that you're in a similar space, in operating in a similar space. You're also not necessarily focused on a return in a certain amount of time like a VC might be. VC funds typically have a 10-year structure. They need to give money. They need to get money back to their investors. That's not necessarily going to be the case here. But probably most importantly, there are going to be things that are going to be different from your typical financial investor that are going to be very important to you. One is if you have some sort of a commercial agreement, that's going to be a big part of your focus. And we're going to talk later a little bit about how you stage an investment transaction and a commercial transaction in a way that most benefits a CVC. And then also, oftentimes, and this I premise it because it's not always the case, but oftentimes a CVC is not going to be the lead investor. So there's going to be a lot of reliance on a lead to negotiate what I would call all of the standard terms that all of the investors in the transaction are getting. But there are going to be terms that are really critical to you. And that's where a lot of your time and energy is going to be focused. And oftentimes those are warehoused in a separate agreement called a side letter, or they don't have to be called that, but oftentimes they are. And we'll talk a little bit more about that as we go as well.
So having sort of given an outline of what CVC is generally about, I thought it might be helpful to take a minute and talk about some data and some recent developments in the space. So just looking from some third-party reports, essentially the message here is that CVC funding has really been reaching record highs in the last year. It doubled year over year in 2021 compared to 2020. Lots of huge rounds, a lot of activity in the health funding space, a lot of activity in the fintech space, especially increasing 62% by number of deals and doubling the number of dollars. So some big numbers here. Also seeing a lot of work in Asia in the CVC realm, as well as in India, right? It's becoming huge pretty much everywhere around the world. At least it was as of the end of 2021. And so that's kind of the point that I wanted to stop on here is, right, we wanted to provide the most recent data that we could, but of course, this data is talking about 2021 and we're now sitting at the last day of Q2 while we're giving this webinar. And certainly over the last few months, the market has taken quite a bit of a turn and we're in much more of a different position than we were before. And so that kind of begs the question of, where are we actually right now and what does that bode for the future? Definitely in terms of this rise in CVC funding, I can say as a trend, you're seeing more of the side letter terms that we've talked about, more aggressive positioning by CVCs already as the market becomes more familiar with what CVCs are asking for, right? I remember earlier, 5 years ago, we'd ask for stuff and opposing counsel would be like, how could you possibly even put that in something? We would never agree to that. But as you've seen this become a little bit more commonplace, opposing counsel and companies are more used to working opposite strategics and are more used to seeing things. And so they push back a little bit less, which inherently makes, the agreements that we asked for a little bit more robust and we win on those points more. Well, with the economy taking this turn, what I would guess is that we will see that trend continue, at least as far as being able to ask for more when it gets harder for startups to ask for capital. And you see, corporates coming in and strategics coming in and having a commercial agreement that will drive revenue for the companies. I think they're going to be more willing to go alongside these more aggressive terms that they were already getting more used to. I just see that becoming even more of a trend is even more aggressive terms. On the other hand, what I see becoming less of a trend is this idea of CVC, doubling year over year and taking up a larger size of the market. My personal guess, and I think Mike probably agrees, is that we're going to see a little bit less of that. And, I've been practicing for 14 years, and it sort of reminds me of when I first started practicing in 2008, 2009, of where you saw a trend where in the M&A market, there was a little bit less strategic M&A, a little bit more private equity M&A. And I think why is that? Well, because it's the job of private equity to do M&A, whereas for strategics, it's sort of more optional or opportunistic. And when you're, struggling, there's a little bit more of the battening down the hatches and tightening of the belt, right? And so similarly, it's the job of venture capital of VC firms on Sand Hill Road to make VC investments, whereas corporate venture capital is a little bit more opportunistic. And so I would just, wonder and predict that you'll see CVC taking up a smaller percentage of the market than in the last year where it was sort of at its peak, given that, it's a little bit of rough optics to make investments in new companies and new technologies if you're doing reductions in force in your own company, for example, and also that, when finance departments and are charged with sort of seeing where they can cut. If you've got budget that's been allocated to a CVC, because most of these are investing off the balance sheet, it's pretty easy to just pull the money back and reduce some of the funding. And so, while as people that do a lot of CVC work, we're excited for the prospect of there being more of it. I think we'd be remiss if we didn't offer at least that grain of potential insight. And, hopefully we're wrong. So moving along a little bit, wanted to talk a bit about CVC Program Formation, basically how these CVC programs get structured. And there's really, I think, two different ways that you can go about it. And one is to have sort of a separate entity, a separate legal entity, whether it's an SPV or an LLC or corporation or what have you, that does the investing, that has its own officers and board, and that has its own, basically its own bank accounts and its own group, versus just investing, we say, off the balance sheet, i.e. there's no separate legal entity that, the funds that you are using to deploy capital into an investment are really in the general coffers of the corporation overall. And what I would say is that, a vast majority, I would say, of the companies that we work with, they really are doing off balance sheet investing. Even if they have established a separate subsidiary that has its own officers, they're still pretty much investing off the balance sheet and not structuring this as a separate fund. And I think that there's some key reasons for that we'll get into. The other thing to think about is who is doing the corporate venture capital work, like who are the professionals. And what we tend to see is that while some corporates and strategics actually bring in folks that have expertise in venture capital investing, and even lawyers that have expertise in venture capital investing. The majority of groups that we work with, this tends to be part of the overall corp dev group, i.e., it's M&A professionals, both on the investment professional side as well as on the legal side. And there's some implications for that as to how that kind of can play out, but usually the M&A folks get up to speed pretty quickly on the venture capital side of things. So what does a CVC program generally look like if you're setting it up? I think that a lot of this applies, whether you are doing it off the balance sheet and internally versus doing it externally. Either way, a lot of the same principles apply. So one is authority, right? Excuse me. Who is making the investment decisions? Is it an IC, an investment committee, that is composed of investment professionals, maybe the CEO or CFO of the organization overall? They're making the decisions. Is it a smaller group? Figuring out who comprises that investment committee, I think is pretty important, and that's really all sort of a little bit behind the scenes from what we're involved in, although we tend to weigh in a little bit. I think allocation of capital is the other important thing, right? So is this it's not just a matter of saying how much money we're going to put into the program, but how much the investment committee is allowed to invest in any individual investment, and as well as putting other kinds of guardrails around what they're allowed to invest in, what types of deals they have to invest in, whether, diversification, whether they have to go back to the investment committee or back to the CEO or CFO of the organization for greater approval, et cetera. So basically replicating a lot of the issues that you might see in a fund agreement as far as, what you're allowed to do when you have to go to the LPs for approvals in those limited circumstances, but just a little bit more informal. So separately from the delegation of authority point, as far as who's deciding what and how much money, there's the mandate, right? And this gets to a lot of what Mike was talking about. And this is super important for us as counsel to really understand so that we know what to focus on. And that's, is the idea of getting return on investment, is it primarily economic versus are we doing this for strategic reasons to achieve some sort of commercial goals, whether it is bolstering our commercial relationship, whether it is getting a foot in the door for understanding for potential future M&A, whether it's, again, for lack of a better phrasing, blocking other M&A, whether, and what have you. And frankly, not all of the investments are being made for the same purposes. A lot of times it's all of these purposes for the program generally, but individual investments may have more of one focus than the other, right? And so, for example, for some deals, we may ask for, right of first refusals or negotiation around M&A, and then other deals, maybe we don't really care about that because that's not the point of the investment. And so it's really helpful to understand both generally and with respect to any specific investment. You also probably want to set parameters around, the round size and stage, right? Are we doing $10 million deals where we're lead, for Series A, Series B? Are we doing, smaller rounds where we're following on, generally in the $500 to $1.5 million range for, safe deals and Series seed rounds, right? That'll also, I think, impact a lot of how you go about doing diligence and thinking about the overall investment framework, as well as the terms that you might ask for in a side letter. And then the last big consideration that we spent a fair amount of time talking about when we are first setting up a CVC program or thinking about setting up a CVC program is incentives and culture, right? And by that, I think the real issue is, is there going to be carry-based compensation? Are we compensating the investment professionals based off of the success of the portfolio? And I think this ends up really being the key driver for whether you end up forming a separate, entity versus whether just doing it, as I was saying, sort of off the balance sheet. And this is also, I think, the main reason why most of the deals end up going off the balance sheet and instead of having a separate entity get formed. And really the issue here is, while investment professionals working for a venture capital firm, they do expect to get carry-based compensation. That can lead to some awkward and inconsistent incentives when you're working within an overall strategic, because that financial return may not be the pure goal of what your firm is looking for. If it is, this might make sense. If it's not, there can be a disconnect where you're not properly incentivizing the outcomes that you want to achieve. And so that can be, one issue. The other issue is that within a corporation, a publicly traded company or what have you, it can lead to some differences in culture depending on how much those professionals are working with the overall teams and who they're working with, where you have, traditional corporate salary structure versus VC culture where someone's being compensated based on carry, having those people working side by side in the same organization, but with such vastly different compensation structures, can be a little bit awkward, right? And I think that corporations is generally used to people not all having the same compensation structures. Obviously, the executives and management are going to make more than rank and file, and that the sales team is being compensated based off of sales. Like, we get that, but throwing in the carry-based compensation often sort of tends to be just one sort of wrench too far that can sort of really end up resulting in people saying, you know what, let's just go back to just sort of regular salary. We've explored this option. It's not worth setting up a separate LLC that has like the profits, interest, and carry structure and what have you. And so, I think we've seen that a little bit, but the vast majority of corporates that I've worked with, frankly, have ended up, after all these discussions, going back to a more informal off the balance sheet structure. I don't know, Mike, maybe you might have anything you want to chime in about any of your experiences with this.
Yeah, my experience has been similar. I haven't seen many that do the carry-based compensation. And a lot of that is because, like we were saying, a lot of it's not, return on investment isn't necessarily the goal. And so you don't necessarily want to incent your investment professionals to be looking for those deals, right? Then they might not be finding the right deals for you if that's their directive. I do see occasionally, I work with a variety of CVCs that do have separate entities, but they're more for optics than anything else, right? It can be helpful to have an entity that's called, Strategic Company Ventures, right? Instead of just the strategic company name. And that can also assuage some of the anxiety that entrepreneurs might have about, where is my information going after once it goes into these investment professionals' hands? And we'll talk about that a little bit later too, but it at least it presents the image of kind of a standalone group or division that has some autonomy, even though oftentimes it doesn't. But that can, that's something that I do see from time to time.
Yeah, that's a great point. I think the last thing I'd say before we come off of this slide, but just, and this is probably obvious talking to, it's probably a lot of lawyers on the call or a lot of people who've been advised by lawyers, but what you absolutely don't want to do is enter into, sort of an informal carry-based compensation arrangement that isn't documented, because I actually have seen that happen before, where, people were sort of promised a kind of carry structure that wasn't really fully vetted by benefits and tax counsel, and it can just lead to some pretty funky tax impacts that aren't really good for anybody. So if you're gonna do this kind of carry-based structure, it's not something that the normal HR team should handle. You'll definitely want to bring an outside counsel that has expertise in this to help set that up. So we'll turn now and switch gears and talk a little bit, for most of the rest of the presentation, about the actual investment terms, which I think is what most folks are probably interested in that have programs already set up. And so I will turn it over to Mike to start the conversation about the side letter.
Yeah. So one of the elements here that I just want to make clear is not a focus of this session are kind of the general venture capital terms that you're going to see in any deal that are applicable to all the investors, right? There's a pretty well-trodden path of terms that get negotiated in all of these deals. And really what we're talking about here are things that are different to a CVC and things that need to be focused on that are outside of those terms. Obviously, the CVC is going to want all those same terms that other investors are getting. But on top of that, there are a number of terms that are going to be unique to them. And that's really where we're focusing. And so this slide is called side letter terms, because oftentimes, since these are specific only to the CVC, you're going to negotiate these in a separate document. One thing I want to make clear is that separate document or side letter, I feel like a lot of folks that I work with think that that's synonymous with able to keep secret from other investors. And that's not the case, right? These are material terms, and so they're going to be shared with others. And so, a lot of times, we'll have a term that is a little bit aggressive or is a little bit controversial. And they'll say, well, let's just put it in a side letter and then we don't have to tell anybody. And that's not the way it works. And so that's just, one point to make clear off the top. I don't know that we need to hit all of these. You can see what they are, but Fredo and I both have items on this list that pique our interest, and so we'll both attack a couple of them here. Obviously there are some of the basics, right? Basic information rights, basic financial rights. Usually these are things that you're going to get in any deal anyway, but oftentimes there's a threshold or something, right? You have to continue to own a certain number of shares. And that's not necessarily going to sit well with your financial reporting team internally at a CVC. They're going to need that kind of information regardless. And so, there are some points like that I would call kind of non-controversial. And then there are other points, the two here that I'm going to talk about that are sort of near and dear to me are the point about M&A rights and the point about drag-along carve-outs. So M&A rights, as both Fredo and I have mentioned earlier in the presentation, a lot of the time, a CVC is making an investment into a company because it's an M&A prospect and they might want to acquire it down the road. And so if they're doing that, they might, you might be thinking, okay, if this is an acquisition target, how do I make it easier for me to buy them later? Right? I'm giving them all this money now. What can I get out of that? And there are a myriad of ways of structuring M&A rights. Everything from just an all-out call option to buy them to something as low as just getting notice that they're on the market. There are really kind of four flavors that you see most often. Well, let me say there are four flavors that are proposed usually by investment professionals or corp dev teams. There are really only two that I find generally workable, and I'll walk through them briefly. They're highly nuanced, but I'll walk through them briefly. A right of first notice is basically just a right to be notified that the company's on the market or that they've received inbound interest. That is going to be the most palatable to a company. And in my opinion, oftentimes is the most workable, even if you're a strategic investor. It doesn't give you a whole hell of a lot, but it gives you enough to go on, and it allows you to mobilize and determine whether or not you want to throw your hat in the ring. The next sort of level up in intensity of that is something that you might call a right of first negotiation. It's really where you get notice of all that same thing, but then the company also promises that they won't negotiate with others, or that they at least won't enter into exclusive negotiations with others for some period of time so that you have time to come in and make your case. Now, that's probably making the entrepreneur a bit skittish at that point. The question to the entrepreneur will have is that going to chill the market, right? When third-party buyers come in and they see that, and they see that their deal is going to get put on ice while they go talk to an investor who has this right, are they going to lose interest? And I think that's a fair question. The next level of intensity is something called a ROFR, a right of first refusal, and I'm sure a lot of you have heard about this. And oftentimes you hear that being the default that investment professionals want. Hey, we want a ROFR, right? If somebody comes in, if a third party comes in and offers to buy them, we want to be able to swoop in and just take that deal from them on the same terms. That absolutely chills the market. So have I seen it? Yes, I've seen it. Do I see it a lot? I do not. And it's certainly something that we can negotiate, but I would say oftentimes it's not a 1 point, because it just chills the market too much, and the board, the board of the company has their own fiduciary obligations to all of the investors, and if they're consolidating the market too early, that can be a problem. The last one is just a straight up call option, right? And I see these on occasion. I see them asked for on occasion, and I'll share here the advice that I typically give, and that is call options are most often not the right answer. And the reason for it is that there's a difference legally from what most business folks think you're getting when you have a call option. What most business folks think you're getting when you have a call option is a right to basically just come in, drop a piece of paper down and say, we're buying you today, and it's done. And that's what they tell their leadership, right? The reality is that that's very often not the case. Usually a call option is where you agree on a price but you don't agree on other terms. You don't get the governance consents necessary from the board, from your stockholders that are required in order to do a deal like that. So there is a lot that could go wrong and a lot of flexibility for the company to get out of that deal. And so you can't go to your leadership with a straight face and say that you have this deal in the bag and there's no way a competitor could ever buy it, or that it would ever get swept out from under you, because that's just not going to be the case. It is only the case if you actually negotiate the full-on M&A deal up front. So you would make your investment, you would do all of your M&A diligence, you would negotiate a full-blown M&A deal, sign it, get it approved by the stockholders. And the only thing you need to do in order to close that deal is deliver a notice saying that you exercise your right to do that. And most people don't have the stomach for that. That is a huge undertaking, and that's not usually what's on the table. It is on occasion, I've done a few that have actually been very successful. But if you're not negotiating the entire M&A deal, in my opinion, it's better to negotiate something that's more along the lines of just a right of first notice, because otherwise you're introducing terms that you have to agree to, like price, without really getting the benefit of being able to negotiate anything else.
Just to double click on this point, Mike, if you don't mind, but like you got it, because a lot of times like our corp dev team sort of ask us like, well, why? Like, why can't we just do it? And it's like, well, all right, you think about a merger agreement and acquisition. You're negotiating all the reps and warranties, all the indemnities that have the risk allocation, right? All the interim covenants around regulatory for HSR, maybe CFIUS, whatever. When you're buying this company down the road, you probably may need to get HSR approval. There may be issues that have come up in litigation where you want to allocate those as special indemnities. So you've got to negotiate a full-fledged merger agreement at that time. You can't just say, I'm buying this, or even if you could, would you really want to, right? So that's why you really can't do it. It's not like a right of first refusal on the stock, and the right of first refusal and co-sale agreement, where literally, you might be buying 2 or 3% of the shares, and really all that matters is the price, because there are no reps anyway when you're doing a secondary sale, right? And so that's what people don't get, is like, well, we've got a ROFR on the stock and the ROFR agreement. Why can't we just do that for the whole company? Well, it's because buying 3% is really different than buying literally the entire company, taking a control position.
That's right.
And I'd also say, just to echo what Mike said here before I give the floor back to him, but I've done plenty of deals, dozens, if not over 100, that have had a right of first notice, or even like a right to negotiate alongside someone coming in. I've only done 3 deals that had anything close to like an actual ROFR or call option. So one of them, we did actually attach a full-blown acquisition agreement to the end of it. That deal ended up, taking about 3 times as long to negotiate as it should have, cost a ton of legal fees, and the company ended up, not performing very well and going into bankruptcy. And so a lot of wasted time and fees when they could have just, spent the time closing the deal early and then growing the business. The second one, there was basically a short form agreement where we had provided some basic principles so this person could have a call option. We are the company side on that one. We agreed to it because we kind of, I guess, had to. And then sure enough, as part of the next round of financing, the investors came in and said, there's no way we are investing with this side letter having this provision in it. And we're only going to invest if the CVC waives that provision. And sure enough, the provision was waived. So all the negotiation around that, a bunch of wasted time because it got waived, because any reasonable investor is not going to want to invest with a call option on the company. And then the third time was actually just quite recently, a few months ago, where we did end up negotiating sort of a right of first refusal process. I did reach out to Mike and some other people at the firm to try to figure out who had seen this, but very few people had really good exemplars. And so we kind of just were able to come up with something that had a sort of, okay, well, we offer, then the other side can counter offer, and then we can counter to that and then they can counter to that as long as like 15% more, to sort of like make sure that there's some kind of process to go through, and but even then we'd still have to negotiate the merger agreement, et cetera. It ended up being kind of thought it was well thought out as well as it could be. In the end, the company didn't even negotiate it really, I think because they were so early stage that they just didn't have the gumph to fight it. And they probably also figure that it'll get amended away later on anyway.
Yeah, all very true. Appreciate that. Sort of on the flipping the coin a little bit, but still on the M&A topic, drag-along carve-out. So for those unfamiliar, a drag-along is basically an obligation that investors sign up to during a venture capital financing that basically says if some threshold of the stockholder base agrees to an acquisition opportunity, then basically everybody else agrees to go along with it. And the way that you define go along with it is quite broad, right? It's basically you should do everything that is needed in order to get that deal done. Now that can be quite scary, right? Think about it. Think about if your competitor buys that company and says, as a condition to doing this deal, every shareholder needs to sign a non-compete, right? Every commercial agreement with a competitor of ours needs to be terminated. Everybody needs to sign a broad release, waiving any claim that they could possibly have against me, the buyer, right? And so now potentially, arguably, you've signed up to an agreement where you're going to promise to do all these things that could be quite detrimental to your business, and that's just not going to be acceptable. So within the market, there are exceptions that are well defined around not having to sign a non-compete, right? Not having to sign a release against a buyer that goes beyond just the extent of your ownership in the shares. Not having to terminate any sort of collaboration agreement or commercial agreement that you have, or modify its terms. Those are going to be critical to any investor, right? But they're absolutely critical to a strategic investor, and so you need to make sure those are present, and where they are placed within the documentation can actually be important. And that's the reference that we have here to needing to go in the voting agreement. Oftentimes. We'll ask for these carve outs, and the other side will say, well, can we put them in your side letter, right? So they're only applicable to you. And the answer should be no, because the side letter is an agreement between you, the CVC investor, and the company. The voting agreement is an agreement, which is where the drag-along provision sits, is an agreement not just with the company, but with the other investors, right? If you refuse to take one of these actions that's called for by the drag-along provision, it's not just the company that can enforce that drag against you, it's other investors. And the other investors aren't going to be party to your side letter, and so those carve-outs aren't going to be applicable. So they really need to go in the voting agreement, and you need to have control over modifications of those. The voting agreements and the rights and obligations that come with it are oftentimes waivable or modifiable by a majority vote that you may not control, or you are likely not to control. And so you need to make sure that these can't be swept out by a financial investor who says, you know what, I'm exiting this space, so I'll sign a non-compete. I don't care, and I'll waive it on behalf of everybody, and we'll get everybody to sign non-competes, right? That would be a horrible outcome. So that's another thing that we tend to focus on.
Few other things to think about are just that a lot of times, corporate venture investors, even though they're strategics or publicly traded companies for the most part, are often, and they may have additional sort of regulatory concerns, particularly if you're in a regulated industry, that can sometimes go in these letters, as well as sort of a put right, not to actually get your money back. No company's going to agree to that, but like, we can put our entire position for $1 if we'd rather just walk away from this investment and not have it on the balance sheet and have to be associated with this because of publicity and reasons. Another thing that we sometimes see in these letters is where there's a commercial agreement that's happening in parallel but doesn't really get done in time. Having some kind of RFP over commercial deals, or like a branding clause that basically says, like, you've got to give us prior branding or like the right of first refusal on a commercial deal. The basic idea being it can be a little bit embarrassing if you've invested in a company and given them $2 million for their Series A round, and then they go off and announce a commercial transaction with your biggest competitor, and everyone sort of has egg on their face from that one. So just having a few clauses to try to tie that up a little bit, and sort of like a mini commercial deal if you don't have the commercial deal going on the side. One other thing that's sort of not on this slide, but just sort of thinking, as a lot of corporates are public companies, and also operating internationally, and jurisdictions like Europe and the UK, where there's a lot more rules that are coming out around ESG and human rights and upwards reporting and public reporting about making sure that everyone in your supply chain, as well as everyone down your company, your subsidiaries, are operating in compliance with human rights rules, or have an upward report like carbon emissions, et cetera. I wouldn't be surprised if we don't see riders start appearing for those public companies that have those concerns and have those operations, about making sure that, to the extent that they end up having larger positions in some of these portfolio companies that they're investing in, that those companies have to do upward reporting and attestation themselves, if that attestation is going to be reasonably required for the publicly traded company itself. But that's sort of I think the cutting edge of where we'll be, and we'll see if how much that does come to pass. Yeah.
So if you're on the CVC side, one of the things you're probably wondering is, okay, I'm going to get all this information from this company. What can I do with it, right? And if you're on the entrepreneur side, you're thinking, where the hell is my information going? Once it hits the strategic investors' offices. And so, one of the things to know here is that from the entrepreneur side, you're absolutely going to be concerned about where your information goes. What I would say is on the CVC side, there should be an equal concern, right? There are limits on what you can do with this information from a couple of, in a couple of different ways. You have likely signed a non-compete, or excuse me, an NDA, non-disclosure agreement, that says something to the effect of, I'll only use this information to monitor my investment, or sometimes something a little broader will get negotiated. But there are contractual limits. There are also reputational limits, right? If you get the reputation for coming in and raiding information and misusing information from portfolio companies, you're going to have a very short-lived CVC program. And so things are walls are put in place, and this is where like I was mentioning before, where if you have a separate entity, it can be helpful. It's not necessary, but it can be helpful to explain to entrepreneurs the universe of people that will have access to this information, right? You'll have folks who are part of the the venture team, and they'll likely have some sort of a clean team or wall arrangement, a policy internally to not share that with operating companies or the operating parts of the business. I do see from time to time clients who come to us and they say, in order to diligence this company, or in order for us to really understand it, we want to get our core, business unit in there and really kick the tires on. We want them to look at their code, and we want to do those stuff. And oftentimes they're doing something competitive, right? Or they're doing something in a similar space. That's not going to be a good idea. It certainly the BU is always going to be interested in doing that, but that's not going to be in anybody's interest long term, particularly if the relationship sours. It could end up seriously backfiring and limiting what your company can do, since you've had access to that information. At the same time, you want to make sure that you don't put in all this money and then just get access to nothing, right? And so what's often one of the key focuses of the negotiations is whether there are triggers or events which if they happen, you lose access to information. The most generic one that you see in a lot of deals is the concept that you lose rights to information and access to the company and its progress if you're deemed to be a competitor, right? That's not a good outcome either. If you put in all this money and then all of a sudden the company says, well, you're a competitor, so actually all this information that you thought you were going to get, you're not going to get any of that. That's not going to be a good day. And so that usually gets negotiated to say, look, if we're putting in this money, you need to agree that we're not a competitor. And I would say 80–90% of the time, it's as easy as that. The other small percentage of the time, it's something that the entrepreneurs are really focused on. And I've spent several weeks before negotiating what competitor means, and what events might occur that would put an investor over the line. And so that can be an area of focus. And then the last thing I'd hit on here is, a lot of the time, CVCs, they don't necessarily want to blur the lines on who their fiduciary obligations are to, right? If you're a fiduciary of your company and then you also join the board of a target company or of a portfolio company, you are going to have conflicts, and that can be challenging to navigate. And so a lot of the time, CVCs don't want to sit on the board, but they still want access to the board meetings and everything. And so they'll take a board observer seat, which is a non-voting seat that isn't accompanied by any sort of fiduciary obligation, but they still get access to most of the meetings. There are portions of it they may be excused for, particularly if they introduce conflicts of interest, if they're talking about, relationships with your company. But those are ways of helping to manage that. Let's see. In order to not run out of time, let me just be brief on this one and just kind of boil it down. Boiling the slide down, it's really, CVCs, you often want to be the only strategic investor in the round. And so you look to negotiate, elements of exclusivity or notice rights of other people coming in so that you can try and top them in various respects. And these are going to be sensitive issues to a company. So they often get negotiated, but this is where the lion's share of the negotiation is going to happen. And you're going to think through things like, duration of rights like this. Do they last forever, or are they limited in time? Maybe that depends on whether or not you keep participating in future rounds of financing to some certain level, right? There could be what they call a pay-to-play element to it. And most critically, oftentimes there's going to be more than one CVC in a company. And so how do you deal with that if CVCs want equivalent rights? I've seen it in a variety of ways. If the company has enough juice, nobody gets the rights, right? But in other companies, they all do, which means that they all have to play together, which usually means a watered down set of rights, but there's still something there. And then that's one of the times where it becomes really important. Now you need to be looking at every single side letter to make sure that nobody's getting rights that you're not, and making sure that everything is equivalent and nobody has a leg up. So I'll leave it at that for that slide.
Another thing to think about is diligence scope, right? That's part of every deal. And so what do we care about, especially when we're usually not the lead here and usually just putting in a few $1 million, or maybe more than that, but still not as much as the lead. What's the diligence scope going to be? And I would say that in my experience, across a variety of different industries, sort of compliance and reputational risk tends to outweigh the risk of diligence that you're looking for from a sort of financial perspective, right? Like, you're not so much concerned about confirming that the company is going to be okay from random legal issues or that you'll find in reviewing the commercial contract, but rather making sure that the company, the corporate, doesn't get embarrassed and put on the cover of the New York Times for having invested in some company that has a major compliance issue that can sort of make you look bad, I guess. The flip side to this, and where you sort of need to be a little bit balanced and sort of think about the overall approach here, is that when you're doing a CVC investment, right, okay, you're going to be doing maybe some diligence on the company that you're investing in, sure, but from this sort of compliance and reputational standpoint, what's going to be the greater risk, right? Is it that you've invested in 2% of their equity, or that you've got a commercial arrangement with them where you're using their products or integrating their services into your own, right? And so if they have a data breach and you've integrated their services into yours and relying on them for security, then the fact that you're invested in 2% is kind of incidental. It's the fact that you've been working with them, right, on the commercial side. And the vast majority of commercial deals are not going to be going through the same level of legal diligence that you would for an investment deal. So it's sort of a balance of like, are we just happening to do diligence on the companies that we are working with that we happen to also do an investment in? And if so, is that the best use of resources? This is always ends up being sort of a struggle for every CVC program I've worked with, is sort of figuring out that balance, of how much diligence we're going to do on these. And there's no really, I think, solid answer. And it's just a matter of having a conversation and thinking a lot about those goals we talked about earlier, as well as what you are concerned about from the company perspective. Again, one of the things that we've seen a little bit is also making sure that we don't have oftentimes directors on the boards, both for the issues that Mike talked about, but also for liability reasons, and blowback tends to be a little bit more maybe let's just leave it to an observer, and that's just one more reason there. I think the last thing that we want to talk about before jumping into some Q&A is a little bit about the overall deal timing, which we've alluded to a bit before. But with the idea of CVC overall being that you are wanting to enter into a commercial relationship or strengthen a commercial relationship, for the most part, not just doing this for financial reasons, a lot of times you are working on the equity deal or equity investment deal along at the same time as you're working on some kind of commercial joint venture or other kind of commercial transaction. So here at MoFo, as with some other firms, right, it's like the corporate team, with me and Mike, with some of our partners in our technology transactions group, the TTG group, like working on the commercial side of the house, right, as well as maybe doing some of the diligence. And so, you know, those processes oftentimes run in parallel, but they usually don't ending together. More often than not, the corporate side, you know, the equity investment side is done well before the commercial side. And so how do we tend to manage that, given, you know, some of the issues that I mentioned earlier about wanting to make sure that we're getting the benefit of the bargain for what we're putting in, you know, as far as, you know, not having them go off and work the competitor. And so, you know, a lot of times what we'll do is make, you know, again, have the side letter, but have that side letter include some of those terms around like branding or RFP, or even sort of mini commercial terms or a mini MOU in them. Sometimes we've sort of obligated the company to negotiate a good faith for, you know, 90 days to complete a commercial agreement along the lines of an MOU that's attached as an exhibit to the side letter. We've even done that. Sometimes you might tranche the funding, right, and say, okay, we'll put in, you know, $1 million now, but we'll put in the next 4 when the commercial agreement is signed, just so that we can sort of come in now along with everybody else, you know, and get, you know, you'll have our good faith, and then, you know, if we for whatever reason don't come to agreement on the commercial terms, then we're not going to put in the other 4 million, right? I think that the put or redemption rights are pretty rare. That I think tends to be, you know, more where for larger amounts and then where there's like an opportunity for the company to be sort of refinanced, or where another investor is willing to sort of step in and back it. But otherwise, that's pretty rare. As well as I think what's more common is the idea that, you know, if the commercial agreement doesn't get signed or gets terminated or whatever, there's something wrong with the commercial relationship and it just doesn't proceed, that we have the ability to sell in a secondary sale, right? Whether you'll include us in the tender offer the next time you do a financing, or that you'll facilitate the sale of our stock to investors that reach out to you and say they're interested, but you'll just sort of like go a little bit of the extra mile to help us sell. So I think that's it, and we can turn to some Q&A.
Yeah, so I've got a question here. So one question is whether we see, when we do see call options in the rare event, do we see them get negotiated kind of the way that you see, you know, typical calls and puts in a, you know, in some sort of like a buy-sell arrangement where it's where the sellers basically say, okay, well, if you want the call, then you also have to agree to a put. I will say that I have not seen that in the calls that I've done. I think that could be challenging, and if it were a requirement, I suspect that the buyer or the investor would let out.
Yeah, I agree with that. I haven't. You see the put call duality for like sales of stock interests, but not for the acquisition of a company. Haven't seen that.
That's been my experience. We have a question about drags in general and how often they're actually enforced in M&A and whether we see that a lot. I will say that I have seen them threatened. I've never seen one actually exercised where, you know, somebody put pen to paper signing on behalf of somebody through the proxy because they wouldn't go along with the deal. I think in general, buyers shy away from that. At the same time, you know, my advice to a CVC would be, do not let that detract from getting the carve outs that you need, because, you know, if push came to shove on something where you've got a competitor that's buying that company, that's just not a situation that you want to end up in and have to manage. And then we've got some questions about sort of international, you know, what changes in the international context, you know, coming in, you know, if it's a CVC from outside, and, you know, whether there are other regulatory issues.
Yeah, you know, I think that one thing to think about is, you know, we're used to a lot of the venture capital investment coming in from, you know, Sand Hill Road or maybe Austin or Boston, right? But a lot of CVC is especially at a firm like ours, we're dealing with international companies that may be coming from, you know, Japan or Europe or what have you. And so one thing to absolutely watch out for is CFIUS. Pretty much every deal you have to do it, which can be quite a pain, because sometimes these are really small investment amounts, but there's no threshold from the CFIUS standpoint as far as when you have to be concerned about it. Even the first dollar, you know, the first percentage point can be of concern. So making sure that you're looping in CFIUS counsel early and doing a preliminary analysis can be pretty important there. You know, you also want to think about, you know, antitrust, right? Depending on how big the investment is. Usually antitrust is hardly ever really an issue for venture capital generally. And especially for CVC, it could be a lot smaller amounts. But if you're doing larger investments, you got to think about that as well. And oftentimes, more in the overall, less so much HSR and more like Clayton Act perspective of having lots of different investments in lots of different portfolio companies in the same area, and just making sure that you've run it by antitrust counsel from an overall antitrust perspective, not just like the HSR filing thing, but the more broad perspective, as well as thinking about that when it comes to some of those confidentiality issues around getting IP and what kind of information you're getting access to. In both cases, sometimes we'll see inside letters restrictions on what kinds of information we're going to get, because we do have these concerns around getting technical information that we're not supposed to have, or making sure that we don't want to have any kind of anti-competitive issues on the commercial or sales information side of the house. Incidentally, there have been a few questions about for housekeeping about recordings, and yeah, this is being recorded, and we will provide the recording later.
There are a couple of questions about leading around versus not leading around. There's one thing I'd like to say, but I mean, leading around, there's not necessarily more magic to it, except there may not be some sort of financial investor there to sort of piggyback on for, whether it's diligence purposes or negotiating the financing documents. But I would, one thing I just want to say about diligence in general is that diligence in investment deals tends to be, I would call, lighter touch than in M&A. Where things really get kind of challenging is when you're looking at a company as an M&A prospect, right? Because you don't necessarily want to or have the budget during that investment deal to go full bore on an M&A style diligence. But at the same time, it would, the deal team would have egg on its face if it didn't do enough diligence to find out that there's something just absolutely toxic, in the diligence that would have said, look, we'll never be able to buy this company, so let's jettison the investment. So there's always this balance of, how much diligence do you do? And I think that I don't know that that's driven as much by leading around or not, but it's just something to always be aware of.
Yeah. And one of the questions I think was asking about a little bit more deeper dive on the conflicts of interest between the CVC and the portfolio company. And, the answer is yes, this is endemic to the issue. And it's why, when I'm working on the company side as company counsel, as much as I love doing CVC, on the company side, I'm like, you don't necessarily want strategic money, right? There's advantages to it, but you got to think really careful about that because of those conflicts. And they do play out in a lot of different ways, right? I think for this presentation, we've mostly been speaking from the perspective of the audience being on the investor side of the house. But you got to think about, as the investor, making sure that you're managing that. So, I think as Mike mentioned earlier, making sure that we're not a competitor clause, right? Because a lot of times in the investor rights agreement, it'll say you don't get the major information rights or the right of first offer on new deals if you are a competitor, right? We want to make sure that we're not considered a competitor. In the ROFR agreement, it may provide that you're not allowed to sell without approval to a competitor. We want to make sure that we can exercise the ROFR rights and be able to buy up when people are selling. Right? So that's important. Also making sure that in addition to the management issues that Mike talked about in terms of keeping different groups siloed, thinking about who's going to be the observer, right? So I would tend to advise that, you want your board observer to be someone that has like a financial background, right? That they went to B school, they went to management school, they have an econ major, that kind of person, and not the person that has, a computer science degree or an engineering degree, and it comes more from the programming and coding side of the house, right? Or what have you. Basically, you want the commercial people, the tech people, the product people to be more on the commercial side. And you want the observer really to be able to say with a straight face, I'm here to monitor the investment. Obviously, that's the case because I have worked as an investment professional, in my past, and that's really consistent. You also might see a little bit more negotiation in the NDA, both up front or the NDA clauses in the side letter around residuals clauses, which can be really heated and frankly can sometimes open up a whole can of worms and alert people to issues that may not be there, especially if the company side and their counsel is a little bit less sophisticated about these issues. So sometimes staying a little bit silent on that might be better than alerting to them about that inherent conflict more than they may already be aware. So we're at time, and so thank you everybody for attending. As mentioned, this has been recorded, and we will go ahead and circulate this afterwards. And for those of you whose questions we weren't able to get to, apologies. Do please feel free to email me or Mike, and we'll try to circle up with you afterwards. Have a great day, everybody.
Thank you very much.